Well, nice timing on the hit today, Kevin. You got some charts. I got to say, I'm going to put this straight. They're scary as hell if you're a bull. Kevin, let's go firstly to these that keep showing what look to be tops at previous points in history. U.S. stocks versus financial conditions. Your argument is it does not get any better from here. Walk me through it.
Well, Oliver, yeah, thanks. So in past at past market peaks, we've seen similar setups with financial conditions. Here we're looking at the Goldman Sachs Financial Conditions Index, and two of the factors that get the most weight in this index are credit spreads and interest rates. And so when you have record low interest rates and record low credit spreads at the same time, it's no surprise that these are speculative times. And we've seen prior peaks, whether it's the tech bubble, the housing bubble. When you have financial conditions that are just too easy, it's not any different this time. But people are saying that, hey, it's different this time. Interest rates are so low. But remember, back at those times, like Jim Chanos was out there telling folks here recently, it was the Bernanke put back in back during the housing bubble, or the Greenspan put during the tech bubble. People think the Fed's got your back. Well, it's really, they thought that back then as well.
So, Kevin, if we keep this up for a sec, obviously there's a few instances where this worked better than others. For the most part, though, it went about 5 for 5. Now, some declines obviously bigger than others. We kind of had a scare like this during the last bull market. It didn't really pan out. We just had that sideways grind during 2015 where we kind of went to the side. Then in 2018, we had that short blow off top, but we recovered pretty quickly. So which does this look most similar to in your mind? I mean, we're at new lows for this financial condition, so maybe that's closer to the 2000 area. I mean, it looks like maybe .com is a little bit more comparable, but that might be, still months away, many would argue. It could be a year away.
Well, it certainly could be. However, we have extreme financial imbalances today, not just extreme financial conditions, but not only record valuations. We're 30% higher valuations relative to the tech bubble peak when it comes to the tech sector as a whole. You've seen you guys were just talking about the JP Morgan report saying it's maybe time to cash in some chips on software as a service stocks. I mean, the multiples in some of these stocks are incredible. Of 40, 50, 100 times revenues on a company like Zoom, for instance. So the setup is very similar to the tech bubble in a lot of ways, but it's not just tech stocks that are expensive. It's the entire market. The median enterprise value to sales ratio for the enterprise value to free cash flow ratio for the S&P 500 is 50 times. It's the highest it's ever been. 50 times, multiple, 2% free cash flow yield, basically, at the same time as we have record corporate leverage. So, and there's other technical imbalances we could talk about today too, but the market sure looks like it's set up to fail here.
Kevin, this morning we had the chief financial officer of Applied Materials on. I know you know the stock, semiconductor parts supplier, and the stock has had a great run. And I'm kind of made the case to him to ask him to disprove the notion that quarantine and valuations have pushed forward the ability of these companies to kind of grow at the pace some expected, that some of that demand might have been accelerated. And he basically made the case, got to say it was fairly compelling, that there is so much development happening for tech that's still going to happen, that there is essentially almost infinite demand for chips, for technology services, and that even if we did fast forward some of that every dip will be a buying opportunity. I mean, how do you dispute some of the tech that is so revolutionary that people say is going to last us for years? I mean, people thought the folks at ARK were crazy when they said Tesla was worth a couple $1,000s, and suddenly we're like a third of the way there.
Well, valuations do matter, and that's one of the problems. Today certainly, the growth stock idea and the growth coming from the technology sector is real and is higher than a lot of other industries and sectors in the marketplace. But the question is, what do you pay for that growth? And the whole idea, I think, behind the J.P. Morgan call today was it's time to rotate out of growth and into cyclical stocks. But the problem is that cyclical stocks are record expensive today too, and the most leveraged they've ever been. And so it's really hard to to figure out where to go. Everyone wanted to flock to growth in the pandemic. It kind of made sense, but are there other places that might make even more sense to flock to? Certainly, one area that we like is the precious metals market, and with the record global debt to GDP and the record money printing that is going to be necessary to deal with this. We think that that there's opportunity for people to rotate out of overvalued stocks and into precious metals.
Kevin, here's where I have trouble with the gold move lately, just because I'm following the price action here. Today we had a hard rejection of gold as it tried to get back into a range that it had been in the previous 3 months. We're still downtrending. Nothing's changed, to your point here, on the debt levels. Nothing's changed, for the money supply. All these things still fit the narrative that the gold bugs say. But the one that still kind of makes me scratch my head is about rates, where throughout the gold run, the last 18 months leading up to August, I constantly heard that negative rates were an inevitability, that central banks were never going to be able to pass the baton to the fiscal side. Yet right now, in the middle of a global pandemic that totally just ripped everything apart, the U.S. has not gone negative rates. We're slowly passing the baton to fiscal. I mean, is that narrative not breaking down here a little bit? Is that not part of the reason why gold has started to let up here? Gold basically stopped selling off like to the day when fiscal talk started coming together about another round of support. And when Jay Powell said, I'm done for now. When Jay Powell said, I'm done for now, gold has stunk since then, Kevin.
Well, gold certainly had a pullback since early August, and that's understandable. It's reasonable. The precious metals industry was the leading industry group coming out of the March pullback, and had a huge run. What's nice to see is that silver, relative to gold, the silver to gold ratio has improved since those March lows, and we see. But you talk about negative interest rates, and what really matters for gold is negative real interest rates. And since the Fed, stopped printing money a few months back, it's true the gold market has settled back, and real interest rates have also had a bit of strengthening. But you look at real interest rates just in the past couple of weeks, and they started turning more negative again, so declining. And that is really one of the major drivers for gold. The two major drivers for gold are declining real interest rates and negative real interest rates, and secondly, of course, the money printing. And with the record global debt to the GDP that we have, with the fiscal stimulus and the fiscal deficits that we have, and there is the $8 trillion of treasuries that mature over the next 15 months. There is going to be more money printing, more Jay Powell accommodation coming in, and that combined with real interest rates declining again is going to be the driver for a new phase in the still very early bull market for precious metals. Okay, so that gives us something then to look for, right? That's a call and a view that you have about what central banks still need to do. So that's something we can keep track of here, and I like that point about kind of what to look for next. To come back, Kevin, because that's one way that you're looking to play the view here, but just to come back to the equity market overall, the percent of members in the S&P above the 200 DMA, that's also elevated. Everyone knows about the put call by now, which is like crazy low, only goes back to .com for this long under that 0.4 ratio. Kevin, but if I look at this and I get the message that you're sending, and then you also mentioned earlier that a lot of the value stuff is too expensive in your mind. If not gold, then where else? I mean, what makes sense then if so many of these companies are overvalued? Well, the alternatives really are bonds, cash, precious metals, commodities. But there are alternatives to overvalued stocks at large, and commodities and the precious metals space are shorting stocks. Sorry to jump in. Are you shorting stocks? We are. We still remain short. We've had to exercise risk control in this rip roaring bull market here, but that's what you have to do in order to stay in the game and be able to add more to those short positions once the market really does start to break down here. So we're poised to. We are still short, and we're poised to increase our shorts here.
What's the best thing to short, Kevin? If you can't give me a stock for compliance, an area, just tech? I mean, do you take your valuation list and just start at the top and short from there? Sorry to rush you, but we're almost out of time. Got like 30 seconds.
No problem. Look at the Nasdaq 100, okay? I mean, it just had that false breakout. Check it out. I think it's down about 2% today and breaking down below that level. So that'd be a good place to look.